Wanted to make a video today about debt recycling. I get questions about it all the time. People want to know about it. People want to do it. And it's one of those things I think anybody that is an investor should know about. Anybody that has any non-deductible debt absolutely needs to know about. And at that point, it becomes free money. And it's just one of those things that once you understand it, it'll click and you got it for life. And then you can use that forever to save yourself some money. Quite a bit to go through here, but I'm going to start with the simple, what is debt recycling? Let's have a look at an example. Basically, we're going to turn non-deductible debt into deductible debt, and we're going to use that so we get a tax deduction and then we get more money back on our tax return, or you can do a PAYG variation, but whatever you do, you do. Okay, so in this example, this is probably as vanilla as it comes. So we have an $800,000 non-deductible debt here. Now, we're going to pay that loan down by $200,000. So we're going to pay that loan all the way down to $600,000 of non-deductible debt. Then we're going to redraw our $200,000 here, and we're going to spend that on an investment purpose. Maybe that's shares, property, doesn't really matter. That was a fairly simple way of doing it, and what that's done is that's turned $200,000 non-deductible debt that was part of the $800 into $200,000 deductible debt, and then the interest on this becomes a tax deduction, which will be probably thousands of dollars per year in savings here. So that's a very simple version. First, before we go through the more complicated parts, let's first look at the why, the how much, what is the saving. So in this example, whatever reason I changed the amounts, but instead of 200, we've got 100,000 as a nice simple figure. If we take 100,000 as non-deductible debt and the interest is 6,000 per annum, and we convert that into 100,000 of deductible debt. So what does that actually do? That means the interest of 6,000 hasn't changed. That now becomes a $6,000 tax deduction. Now with a $6,000 tax deduction comes lots of savings at tax time or throughout the year, depending on how you do it. Now, here's a little table. You can figure it out for yourself what you're going to do. But if we take 100,000, and this can be used as a rough guide. If your effective tax rate is 30, 37, or 45, then you'll save, depending on the interest rate. If the interest rate is 3%, you'll save the amount in this column here. Now, if you look at the lowest tax rate and the lowest interest rate, saving on 100,000 debt recycling is still $900 per annum. That's how much goes back in your account when you complete the tax return, compared to if you did not do it. Now, if we take the highest tax bracket and a higher interest rate at 6%, then the saving goes all the way up to $2,700 per annum per 100,000 you've debt recycled. So if you've done two, you're going to get $5,400 per annum. In most cases, doing this right will save you a lot more than finding a better interest rate. But as tax bracket goes up and as interest goes up, the savings go up. Now, methods to debt recycle. So the whole premise of debt recycling, step one, you pay down your non-deductible debt. That's fairly simple and straightforward, I think. Then step two is that you need a new deductible loan. Now that new loan can be done through a loan application with a bank. In some cases, you need to do that, but it doesn't have to be. The other one is you can do it through redraw. This is probably the most common and easiest way. If you redraw funds out of a home loan, then that will be considered a new loan from the ATO's perspective when deciding whether it's an investment debt or not, which means if you pay down your non-deductible debt and you redraw back out for investment purposes, that is considered tax deductible. Offset doesn't help us whatsoever because that's not considered a new loan. But you can still sort of save money in your offset and then recycle when you're ready to do so. Now, when do we debt recycle? This one's so easy. Lots of text, but once you get it, this is very simple. So you can debt recycle whenever the following two are true. You have some non-deductible home loan debt. So we can only debt recycle if you have non-deductible. If all your debt's already deductible, then what are we trying to accomplish? So if you have some non-deductible home loan debt and you are looking to spend money on an income producing asset, that can be shares, property, lots of other things, whatever the ATO allows as a deductible expense, that would work. So you can do this very simply. If you like to invest in shares, you can just debt recycle straight into shares. If you want to do it into property, that's how you can make sure you got a high deduction on the investment purpose. But as long as those two things are true, you should be okay to do it. Now, notes on this. So it can be inconvenient. So there's a bit of admin work here. Sometimes there's a small cost, but usually not. I wouldn't personally be doing this if I was investing $500 into the stock market. It's just not worth the effort, in which case you can save money in your offset account, and then when you're ready to debt recycle, then sort of implement it all. Now, another note, there is no do-overs. So you cannot, for example, if you got your 100,000 cash and then you want to buy property with that, you can't buy the property using the 100,000 cash and then try and debt recycle after. You have to debt recycle ready to buy the property because the 100,000 has to be used for the purchase. You can't purchase it and then fix it later kind of thing. All right, now we got a couple of things that just to make sure we're all on the same page. So these are just explanations which will make the next bit a bit easier. So purpose versus security. This is super important and this will be what makes it all click. Now, some people think debt against your owner occupied is non-deductible and debt against your investment is deductible, but not the case whatsoever. It often ends up like that, but that it doesn't have to be the case. So if we have an owner occupied property with debt and we borrowed against it for investment purposes, can't underline, but that would be a tax deductible debt, even though it's against your owner occupied. It's about the purpose of the loan, not the security underneath. Same with investment. If you've got an investment property, but you take out 200 grand, you use that to buy your owner occupied property, or you use it to buy a car and a jet ski and all that. This is non-deductible debt. And here we go again. Redrawing from a loan is considered a new loan, which is kind of the whole premise of debt recycling. So keep that in mind. Next thing we need to understand is limit versus balance. I'm putting this here because this gets confused by people all the time. If I said to you, we've got an $800,000 limit and a $600,000 balance on our home loan, and those are sort of the two metrics we generally go off. The limit is how much you could owe if you redrew everything. And the balance is how much you currently owe. So I could have a $0 balance, which means I owe the bank nothing, but an $800,000 limit. Easy way to imagine that is it's like a credit card or an overdraft. You don't have to owe anything on a home loan, just like you don't have to owe anything on a credit card, but you can still have a limit. Now, the difference between this 600 and 800, that is your redraw in most cases, assuming you have redraw enabled. It's also your available funds. So your redraw on your internet banking will usually show as available funds. So in this case, you log into your CBA net bank and it will probably say BAL 600k and available 200k. That's probably all it would say. Don't know with Combank specifically, but if this was what you saw on your internet banking, that means you have a limit of 800,000 because once you redraw your 200, your balance will then become 800. All right, so now we get a little bit more complicated. I think this is still probably a fairly simple one as far as how we would do it, and this probably makes most sense for if you're purchasing shares. You got an $800,000 limit and balance non-deductible debt over here, and you got 200,000 cash, which you would like to use. Before this starts, you know how much money you're going to put into shares, which makes this very easy. So all you do, you have to split your loan. How do we split our loan? In most cases, call your bank or broker. They should be able to help you with that. Occasionally, you would need to refinance, but more often than not, you submit a form and you say, I would like to split this into 600k and 200k. Both of these are still non-deductible at this stage. Now what we do, we inject 200,000 cash into this other split, bring the balance down to 0 and the limit remains at 200. Be very careful about this step. Some banks, if you do this, they will close the account and now you need to go apply for a new home loan. So do be careful about that step. Sometimes you'd put in 199,000 and redraw the 199,000 and consider that deductible still. Accountants, don't quote me on this, but accountants seem to be comfortable as long as the vast majority is deductible. That would be okay. Now, what happens? We redraw our 200,000 cash, spend it on an income producing asset. Let's say this was shares. In an ideal world, if your bank enables it, you redraw straight to the brokerage account. If your bank doesn't enable it, you redraw to your bank account and then immediately from there to the share account, and keep a record of this, because if the ATO comes and audits you, the onus is on you to prove what you did here. So keep a record, put that into the brokerage account, and now you consider this 200,000 is deductible debt. Now you get your tax deduction. If you're on a 6% interest rate, that's a tax deduction of 12 grand per year, and that should all be done within a week and usually with no fees. Next, we got a mixed purpose loan. These will come in very useful. This makes sense when you don't know what you're going to spend the funds on. So what I mean by that is if you got your pre-approval to buy a property and you have your 200,000 cash, but you might only spend 120, 150, 180, depends what you buy. If you don't know the amount, then it can often be better to sort of start off with a mixed purpose loan. So same example, we got 800 and 800 over here, non-deductible debt. Fully maxed out home loan, we got 200,000 cash and we're going to put that into the home loan, bring our balance down to 600 and 800. Now we go and we find our property and we figure out how much we need. Again, we keep our records, we keep our invoices for our building and pest, solicitor fees, etc. And then it turns out we only had to spend 125,600. Why I picked that amount, we'll never know. So we withdraw that and we spend it on income producing assets. So we can redraw that as we go through the process. You know, here's 600 for your building and pest. Here's your 10,000 deposit. Here's your balance, whatever it is. That's that. And then the remaining 34,000, we can take that back into our personal account. We can leave it in the home loan, but for this example, we redraw it back to our personal account because this is still non-deductible. Now where we end, we have an 800,000 limit, an $800,000 balance, and this is considered a mixed debt. Now this calculation, I hope it's correct, but basically you take the lot, the 800, and you figure out 125,600 is what percent of 800. That percentage of the entire loan is now considered deductible. Mixed loans are very useful, which we're going to get to, but there are problems with mixed loans. So the problem with what we just did is, let's say we've done that and then we want to go do it again. Maybe let's say we want to buy 200,000 worth of shares now, and we've got our existing mixed debt. Now ATO is pretty clear on this. If you pay that 200,000 into there, the 200,000 $200,000, 87% of it will be paying down non-deductible debt and 12% is paying down deductible debt. The ideal situation is that we're paying down 100% non-deductible is what we want. So we've kind of meant that future debt recycling is less efficient. And also I got an extra note here. You also can't make extra payments into just the non-deductible. So if you're trying to pay your home loan off sooner, same effect happens. Your extra payments are starting to pay down deductible debt, not solely the non-deductible debt. TR 2000/2 Tax Ruling 2000. It is called the second exception and it's paragraph 18 and it's about separating a mixed debt. So what they say is if you take an $800,000 debt and you had it 25% deductible, 75% non-deductible, then what would usually happen without this exception is if you split your debt into 200 and 600 as an example, this should technically be 75% non-deductible and 25% deductible, and this one should be the same. It doesn't actually fix anything. You've still just got, when you split your loan, you've just got two mixed debts. Now the exception is that this won't happen. If you match the amounts exactly, then the ATO is comfortable saying that this 600 is now 100% non-deductible and this 200 is 100% deductible. So they will let you take a mixed debt and then fix the debt recycling after. And that becomes, again, super useful for buying a property. So here we go. Hopefully we can stay with me here. So same example as always. We've got 800,000, 800 balance. We're going to buy a property. We've got 200,000 cash. We're probably not going to use it all. So let's figure out what is a nice, easy way to ensure that our debt stays as optimal as possible. So step one, before you even buy the property, you want to do this because when you pay the deposit on the property, you want it to come out of the debt so that it's deductible. So before we even buy the property, we put 200,000 cash into our loan. Reduces our balance to 600. We've still got a non-deductible debt. Then we find our property. Looks beautiful. Now out of the loan, we'll take our deposit, whatever that might be. Let's say that's 10K deposit. And then out of our settlement funds, we'll pay whatever else we want. And you can do building and pests and all that too. Can and should, I should say. Let's say this is our 150K additional. Now we are back to, and then there's a step missing here. And then after we're done, we'll take out the rest of our funds. So we've spent 160. So we'll take our 40K back into our personal offset. Now we end up with an 800K limit, 800K balance, mixed debt. We've done all that because that's a lot easier, because if you don't know the amounts you're going to need, you can't split it up front. So we did all that, made ourselves a mixed debt, but we don't want to hold the mixed debt, because if we hold the mixed debt, our future debt recycling will become less efficient. So now we use that ATO second exception or whatever it was called, and we split it out. So we split out non-deductible debt. We say that is 640,000 and this deductible debt is 160,000. That is probably the easiest way I've found to debt recycle through property, because it's nice and simple and you can fix the splitting after settlement, after all the stress is done, and splitting can be slow. I think I have a slide on that later, but splitting is not always quick, so you can't. And the other problem, if you hadn't done it this and you try to split it once you find a property, some people do this, and admittedly this is what I used to do, but you can try and find a property, then calculate how much you need, then split your home loan. That was sort of the old way I would use. But the problem is you have to split it before you can pay the deposit, which becomes an absolute nightmare. So this way works a lot cleaner and more efficiently. All right, pitfalls of debt recycling. So problems, things to watch out for. I think I have mentioned most of this already, but let's clear it up. So some banks will close a loan account if paid down to zero, meaning you cannot redraw. You split out your 200,000, you put your 200,000 in, ready to redraw it for your property settlement. Hey presto, bank says, okay, we've closed that account. You're in a pickle. So check with, again, your bank or broker, make sure that you are comfortable that that will happen, will not happen. And if it will, you can leave $1,000 or so in the home loan account. And again, this is quite unofficial, but what I have seen is accountants seem comfortable that if you've made every attempt to do it properly, you can do that. So if you debt recycle 199K through a 200K split because your home loan will close, they seem okay to claim this 200 as tax deductible, but that's a question for accountant. Worst case, you made yourself a mixed debt where 99.5% is tax deductible. Splitting a loan is slow. So again, you need to make sure you have the funds available when you need them. If you've got to pay a deposit, if you've got settlement, don't try split your loan 3 days before settlement. Some banks will be okay with that, but for the most part, you're going to miss settlement. So assume that splitting a loan will take a week or two, but that varies bank to bank. And try not to muddy the purposes. So again, the onus is going to be on you. If you get audited by the ATO, you need to prove what you did with the funds. Now, don't put your 200,000 into your loan, then redraw it back into your main account, then go buy groceries, buy yourself, get a massage, go on holiday, and then spend 200,000 on a tax deductible purpose. That 200,000 is not necessarily tax deductible. In fact, it's very likely not, because from what I understand, there is an in and out rule in banking where they can track what money was used for what. So just don't do it. Just make sure it's either you can use a completely fresh account, so open a new account just for this purpose. easy and cheap. Or you can redraw straight from the home loan if it allows you, or if it's going through your everyday account, just make sure it's in and out with no other transactions. Notes on equity withdrawal. So this is probably actually more common, or at least as common as debt recycling, but people, again, don't always quite get it. So if you take out equity, the premise is all the same. So let's say you have a 600 grand existing debt and you come to me and you say, hey Zach, I want to buy a property. It's probably going to be 600 to 800,000, but we don't really know, so we'd like to get some cash out. Most commonly we would just then take out a $200,000 extra split. These are both non-deductible at the time you've taken it out because you haven't spent the 200,000, but if that 200,000 went into an empty account, then you can spend that on deductible purposes and you've got a clear path to your deductible purpose and that will become deductible. Or you can take your 200,000, you can stick it in your groceries account and don't worry about it. And then when you are ready to buy something, then you can debt recycle against this split specifically. So you can put 200,000 back in, start the debt recycle process again. You can always restart the debt recycle process from a bank's point of view by paying down the loan and redrawing. And the other thing, let's say, because this is also quite common, let's say you do this and you're going to buy a property, but then you only spend 160 of this on the property and you're left with 40 back. So this is deductible. Now, if it suits you, you can put this into shares. You can have a deductible split here. So I'd still keep these separated. So when your accountant asks at the end of the year what everything is used for, you can say, hey, this statement here was used for the property purchase. This was for shares. That'll make your accountant's life very easy. If you don't want to buy shares, you can call up your bank and say, hey, can you combine this back into my $600,000 split? And then you'll have 640 non-deductible and 160 deductible. Lots of ways to do it. All right, so debt recycling into a trust. This one gets asked and it is not straightforward, but can be done. You can debt recycle against your personal name and claim a tax deduction in a trust as long as you do it right. So let's start with this drawing on the left, which is probably not as simple as it needs to be, but let's give it a go. So let's say here's our trust. They're going to buy an $800,000 property and they'd like to maximize the tax deduction. So what they'll do, they'll borrow 80% from the bank. That one's straightforward. That's a nice tax deductible debt. And then they need to get the deposit from the individual. Now the individual who has 200,000 available, so this is 160 to get to 800 plus 40 for stamp duty. The individual has their 200,000 available. Now they can simply gift that to the trust, which in some cases is the way because it provides better asset protection, or they can loan the money to the trust. The reason they might want to loan it is because it will allow them to debt recycle in their own name. So if they do their normal debt recycling here, they pay down their 800,000 loan, they redraw it. When they redraw it, that income producing purpose is to lend 200,000 to the trust. We'll look at this from two angles. The trust has borrowed 640 from the bank to purchase a property, therefore deductible, and 200,000 from the individual. Again, because it's a loan, that is tax deductible. So they've actually got an 840 on an $800 property, 800,000 property, they've got 840,000 in deductible debt. Now, from the individual's point of view, what does this mean? If we ignore that 600 grand non-deductible debt, we'll just focus on this 200, say it's a 200,000 split. What does this mean? So they have a cost to the bank of interest per year. That in this example is $12,000. That's 6% on 200,000. Now they also have an income from the trust. Now, in this example, that's going to be $12,000. They have to charge the trust interest, and there's an ATO community posting thing where the ATO responds, and basically they say this interest rate can be the same, but it cannot be less. So we cannot charge the trust 5% if we're paying 6%. It needs to be an income-producing purpose, a commercial agreement, so we can't do it at a lower rate, otherwise it makes no sense for the individual. Most accountants I've seen do accept that and believe that's all kosher. Some of them will actually say that you need to charge a higher interest to the trust so that you have a commercial purpose. In that case, you would borrow the money at 6% and then you might charge it out to the trust at 6.01%. Therefore, the trust makes some money. But let's assume they're doing it at 6%. Then the individual has an expense, tax deductible expense of 12,000, taxable income of 12,000, and they are net zero for the tax year. So the individual does not get any benefit here. The benefit is instead of the trust claiming 640, which would be the normal tax deductibility, they can claim tax deductions on 840. So, added benefit. Now this, other than the complexity, I don't see any cost downside to this. The real benefit is trust get an extra deduction, which you can't offset your PAYG wage if the trust goes into negative. That's not how it works. But if the trust has extra deductions, it will claim a bigger loss, which means in future years, you might be able to use up that loss and get some tax-free income back from the trust. So I would say for the most part, it is mostly upside with a little downside, but there is a few things to check. So one is check all that with your accountant. Absolutely don't do anything based on what I just said. I'm just a lowly mortgage broker. But the other bit is must have a written loan agreement between the individual and trust. Again, talk to your accountant about it. This needs to be a commercial loan where you treat the individual and trust as separate entities. You can't just give them the money. So written loan agreement. Talk to your accountant. Yes, we know that. And again, this is not a simple thing. If it's all too much, don't stress about it. It may also be better to gift the funds to the trust. So again, whilst I'm not an accountant, I'm also not a solicitor, but my understanding of gift versus loan is that if you lend the money to the trust to get this extra deduction in the trust, then the asset is not protected as well because there's no real alienation of funds. Now, what that means is that the trust owes the individual $200,000. So if the individual gets into legal trouble and gets sued for $5 million, then the courts may, again, I don't really know, but the courts may be able to force the repayment of this $200,000 debt from the trust. Now, the trust probably isn't holding $200,000 in funds, which means the trust will be forced to sell the asset. You're still not losing everything in the asset, is my understanding, but you would lose 200,000 of it. So I think a gift will completely alienate the funds. It puts it into the trust and it's there for good. Whereas a loan leaves less from an asset protection, but gives you this extra 12K deduction per year. Here's a pretty detailed table for you. So I won't go through everything here. There's actually 2 pages of this, 1, 2. Now this is on the website, which I'll link so you can look at it. But I spent a lot of time researching, reaching out to lenders to try and figure out what can be done and where. I'll go through a bit of this. Firstly, this column here is not really related to debt recycling, but it's very important for what we do with a lot of clients. So cash out and stated purpose. When we're implementing things for clients, it is very common that people want the cash first. There's lots of reasons to do that. So you might go to a nice cheap bank, a major bank, Macquarie, ING, whatever, and you might want your cash in the bank. So then you can go to a non-bank afterwards, and you would do that because the non-bank will give you higher affordability. So you can kind of max out your affordability on a nice cheap bank, and then you can push your affordability at a higher rate with some of the non-banks. That's one reason to do it. The other one is having it all ready to debt recycle. So it's quite common that we would take out the cash and then we would implement the strategy in step 2. Now, cash out on stated purchase, that should say stated purpose, means that 1, do they need evidence of what you're doing with the funds? And 2, are they going to start checking your affordability on the future one? So what we are trying to avoid is basically if you go to, as an example, ANZ and you ask for 200,000 cash. Now, are they going to hold that approval and wait for you to find a contract to purchase a property? And then they're going to check, can you afford both properties? And if the answer is no, then yeah, it becomes very painful because then you've got 2 active applications, one with ANZ and one with a non-bank, and 2, you run the risk of ANZ declining the cash out, which causes you problems. So it's nice to get the cash and have it there. And this column is there to figure out which one does which. Now, most of them are okay, but a few key things. So lots of them do want to see what's going to happen. They might want to check that you can afford the next one, which means you can't go to a non-bank and push it. And you also can't start doing it in an SMSF, which is another thing you can do. NAB is pretty good. I think UBank and Macquarie are probably the best. St. George is actually fine as well. Westpac, St. George, UBank, Macquarie, they will all go to 80%. They don't need proof, so they don't need to see a future contract for sale. They are not going to need to check your affordability, which means, and we do this all the time, you can go to someone like Macquarie and you can just take your equity to 80%, put the cash in the bank, and then we can implement the next stage. Now, the other ones, can you pay down to 0 without closing your account? That's a convenience thing. With everything here, please check it with the bank directly. Don't wait till close to settlement, pay down your thing to 0, and then it closes and says, Zach, you told me this. Yes, I have taken time, but yes, it is worth double checking this. But here's a few things. Again, ANZ and CBA are just not great for this, whereas St. George, Westpac, UBank, and Macquarie, and AMP in this case are fine. You can pay it all the way down to 0, redraw it out. Splitting. How do you do it? Some of them have instructions, some of them don't, some of them have time frame. It's just whatever they told me realistically. But the easiest ones, so St. George and Westpac are pretty good. But again, you'll see some of them are 10 business days, in which case you want to do it well in advance. UBank, Macquarie, both pretty quick and both pretty easy. AMP is fine. Fill out a form, takes 10 business days. Redraw, they're pretty much all the same. Yes, you can. And the max number of splits. I like max number of splits because if you're anything like me, you will debt recycle relatively small amounts, which means, you know, you can end up with a PPOR with like 8 splits, 20,000 here for shares, 120,000 here for a property, and you can slowly convert your non-deductible debt into a deductible debt. If you can't split it out that much, you can't do it that much. So here's max number of splits. Extra shout out to Macquarie and AMP. Westpac still quite good. And then finally, can you offset different splits was what I wanted to know. Macquarie and AMP and Ubank, again, all do this really well. These three, in fact, probably Ubank and Macquarie, I would say, are the number one for debt recycling. Westpac, St. George, and AMP all look pretty good. You can offset different splits, and why I like that is because, and again, we do this not uncommonly, you might take out a few $100,000 in cash as a separate split. We can set up an offset against that split, which means you're being charged zero. Let me whip open Paint. I got a drawer instead of wave my hands around. All right, so you've got your $800,000 loan, and we want to take out equity of $200,000. So we make an extra split of $200,000, and then we can set up a regular offset account here where you use your regular groceries, regular savings, all that just goes against your normal home loan, nothing crazy. But this equity that we just released, because maybe we won't use it right away, if nothing else, we'll probably use it in a few months, we can actually have an offset here, and we can leave the $200,000 in there. I quite like that. I think that's a nice, neat way, and I prefer money in an offset for a long-term view than I do in redraw for various reasons. And then when you're ready, you know that this was a sort of a clean thing. You had a blank account set up so you can spend this on your tax deductible purpose. That I quite like as a setup, and hence that's why I wanted to know if we can offset against various splits. Again, Ubank and Macquarie, great. AMP, Westpac and St. George, also great. And then there's another table. I'm probably not going to go through these so much, but there is more lenders. Therefore, if you're looking for a specific lender, I may or may not have researched it for you. I think that's it. I don't think we have anything else to go through, so hopefully that explains everything really well. If you've got any questions, feel free to email through. Otherwise, so we are brokers, we are not accountants, we are not solicitors, which I think I've said 4 times already. If you want us to help restructure your loans, if you want us to help find the right bank, get the cash out, all that stuff, we can do that. We would love to do that. Please just reach out by the website. If you need actual tax advice or legal advice, then you'll need to find the appropriate professional.